In today's rundown, we'll look at the new record highs for the market averages after Canada makes a surprise U-turn on trade, heavy speculative call buying in Strategy Inc., and when it's better to buy a low-price stock than its call option. The U.S. tax and spending bill is making its way through the Senate after clearing a key procedural hurdle over the weekend. With a potential $4.5 trillion price tag, the bill could reshape the U.S. fiscal landscape for years to come. If it passes, that is, the bill is hanging on a thread, waiting for a simple majority in the Senate, with a final vote expected today or tomorrow. After that, it slinks back to the House, where it squeaked through by just a single vote. Talk about a nail-biter. Meanwhile, Trump is channeling his inner optimist, hoping to wrap it up before July 4th, but thorny issues like Medicaid cuts and other amendments will likely lengthen the process. In the big picture, the Congressional Budget Office is predicting that the U.S. deficit is going to grow by an additional $3.3 trillion. It's like watching a balloon animal at a kid's birthday party in slow motion. The more they inflate it, the more you wonder if it's going to pop. With the dollar already down 10% this year, it seems the markets are starting to throw in the towel on any notion of long-term fiscal responsibility. It's as if investors are collectively muttering, just when you thought it couldn't get worse, here comes round two. This could spell trouble for capital inflows, inflation expectations, and the Fed's ability to pull any rabbits out of its monetary hat. Amidst all the buzz, it looks like clean energy and EV incentives are taking a back seat, while the old guard, like defense and traditional manufacturing, are getting the red carpet treatment. Elon Musk isn't mincing words, calling the bill destructive, like that one person at a party who snags the last slice of pizza when everyone else is still hungry. Meanwhile, global trade talks are on the clock. Canada reversed its digital services tax over the weekend, reopening dialogue with the U.S. just days after Trump ended negotiations. France says a U.S.-EU deal is within reach before the July 9th deadline. India extended its U.S. trade mission. Taiwan is cruising along with some solid progress, but Japan seems to be stuck in the slow lane, particularly when it comes to autos. With Trump tossing around a potential 25% tariff, that's a curveball that could send shockwaves through the Asia-Pacific industrials. Markets are treating Canada's U-turn as a positive, but the real takeaway may be the playbook: preemptive concessions in exchange for resumed access. Less flexible trading partners could see tariffs snap back quickly, potentially triggering another mini tariff tantrum. Treasuries are playing the role of a well-mannered guest at a party, staying composed despite the massive debt elephant in the room. With the 10-year yields lounging around 4.25%, sure, there's some passive support pouring in, almost like those folks who bring dip to a potluck, but underneath we can feel the pressure of fiscal expansion building up like a soda can that's been shaken too much. While the market is still dreaming of 50 basis points in rate cuts by year end, let's be honest, it's all about what the data says next. Stocks continue to defy bearish expectations and eke out gains after a roller coaster first half of 2025. The S&P 500 and Nasdaq are setting fresh all-time highs Monday amid apparent optimism around the global trade deals, especially Canada's withdrawal of its digital services tax. The S&P is now up over 10% for the quarter, while the Nasdaq has gained more than 17%, driven in part by renewed momentum chasing in tech and easing inflation expectations. Meanwhile, bonds saw modest gains after regional manufacturing numbers Monday came in softer than a pillow fight. The 10-year yield slid down to 4.27% amid whispers of dovish Fed policy floating in the breeze, encouraged by the less than stellar Chicago PMI and Dallas Fed surveys. At the same time, inflation expectations may have eased a bit after oil traded lower as markets priced in a potential OPEC plus output hike. With projections of an increase of over 400,000 barrels per day in August, it's like they're turning up the faucet just enough to keep the global demand from throwing a tantrum. After all, an extra 1.8 million barrels this year is no small splash in the economic pond, just a 1.5% ripple in global demand. Brent slipped just below $67.70, while gold gained 0.5% to $3,300 and is attempting to claw back 2 weeks of losses. A lot of the activity in stockland is end-of-quarter related, and the tone is likely to remain wait-and-see in the next 2 days, ahead of key data due out before the markets close on Friday. VIX is up 5%, along with the S&P 500 after a series of losses and in anticipation of the headlines. In individual options action, Strategy Inc. was serving up some sizable call options trades, nearly 400,000 of them. That stock is sizzling, up almost 6%, and traders are diving headfirst into those weekly 410 calls like they're lottery tickets. Why? Because they're out of the money and set to expire just in time for a little pre-holiday thrill on Thursday. I mean, who wouldn't want to put it all on the line ahead of a flood of economic data before a long weekend, right? And here's the kicker. All that call buying is sending implied volatility through the roof. It's like a roller coaster ride for the adrenaline junkies in the market. Such a classic move we see with those momentum stocks. Investors are just itching to pay hefty premiums in the hope of snagging some sweet short-term gains. Talk about putting your money where your hopes are. Core Scientific, Robinhood, and DoorDash continue to see speculative options flows as shares squeeze into the stratosphere. On the bearish side, American Eagle saw a notable buyer of 25,000 downside puts early in the trading day. ARM Holdings, Ast Spacemobile, and Antero Resources, AR, are seeing relative weakness in higher put activity. Here are some of the option strikes seeing notable activity Monday. Plug Power is up 27% today, trading around 148. And yet, traders are piling into the 150 strike calls that expire in just 3 days. What? Nearly 30,000 of those traded. Let's talk about why that's a questionable move. Those calls are going for 10 cents. And while that might seem like a small price to pay for upside exposure, you're also paying for time decay risk that evaporates fast, especially on a short week with markets closed Friday. Let's break it down. The stock's at 148. If you think it's ready to pop, why dance around like a nervous waiter at a wedding when you could just grab the whole cake? When you buy the shares, you own the asset and skip the race against the clock. Yes, it might cost a bit more to get in, but if the trade does take off, you're happily coasting along without the pressure of needing to hit a magic number by Friday. Now, why is Plug up today? Part of the move could be momentum. Hedge fund Coatue Management disclosed a major stake last quarter, over 4 million shares. There's also buzz from a recent green hydrogen partnership with Allied Green Ammonia in Uzbekistan. Plug Power's ambition is to build out a full-scale green hydrogen ecosystem, but the business model is still bleeding cash, over $2.1 billion lost last year, and more share dilution is likely as they raise capital to fund expansion. So yes, Plug might pop on headlines or hype. But if you're chasing upside, options that expire in 72 hours are probably not the best way to invest for the long haul. The fate of the trade hinges on short-term luck rather than the company's long-term fundamentals.